Let's call the Palaca Police Officers Retirement Pension Meeting to order. Roll call.
Scott Nast,
I'm here.
Matt Newcomb,
Here.
James Norwood,
Present.
Mayor Correa, Hanson.
Should have an opportunity to read the minutes. Is there a motion to accept the minutes?
Motion to accept. Second.
Moved by Matt and second. Is there any discussion? All in favor?
Aye. Aye.
All opposed? Motion carries. Sawgrass report.
All right. Hi, everyone. I'm Liardon Gita, Portfolio Manager at Sawgrass. Thank you for having me here today. Before I begin with the presentation, let me give you a couple of updates on the company. Recently, we made 2 strategic hires at the firm. We've hired back Christine Turner. Going forward, she's going to be the Director of Client Service, Institutional Client Service. So if you have any questions related to the portfolio, please feel free to reach out to Christine or myself. We should be able to help you out going forward. And then in addition to Christine, we also hired Brian Engel. He's our new Director of Institutional Sales, and he's going to help us, move forward the initiative that we want to grow in that part of the business. So we're pretty excited about our future prospects. These are 2 talented people that have joined the firm, so it's very exciting for us. So getting back to the performance review, very quickly, I'll start with the performance real quick on page 9. So far, we're up to a pretty good start for the fiscal year. So fiscal year to date, bond market has definitely bounced back. We had a bit of a rate reversal since the highs that we saw back in October. So if you look at the total return on page 9, the market in total has generated roughly 6% return, and your portfolio has actually outperformed in a very strong absolute market. Since then, last quarter was a bit of a shaky start. It's been, this elevated uncertainty where you have a very strong month in January, then you have a sell-off. And all of that is really related to what is the view of the inflation going forward. Inflation is going to be driving pretty much everything, not just the bond market and the monetary policy, but the risk premium in equity markets and pretty much every financial asset class you can think of. So everybody's zeroed in on inflation. Our personal view is that the inflation is going to be moderating. We should be seeing a 2 handle by the end of this year, just judging by where all the leading indicators are pointing to. It's interesting, the most recent print that we got back last week with Chicago PMI, one of the most leading indicators you can think of, a very important hub for our economy. It just printed a 35 handle. Just to put things in perspective, that's the lowest print we've seen going back to COVID days and really depression level territory. So, looking at the most recent CPI numbers, there's some kind of fuzzy math there going on. There's a lot of imputed numbers that get into the CPI math. If you were to replace that part of the composition with real-time data, we would actually find that the real-time inflation numbers is actually running below 2%. So if we were to ignore the lagging data, which is the CPI numbers, and focus on leading indicators like the PMI numbers, like the job openings that just printed today, they're all pointing to the economy that is definitely slowing down. And we believe that we should see some kind of normalization with regards to monetary policy, i.e., the Fed starts cutting rates soon. We should see at least 1 or 2 Fed rate cuts by the end of the year, and then more going forward. Our base case is for 225 basis points rate cut by the end of the year. I wouldn't be surprised if we become more aggressive. But again, it's an election year. The Fed doesn't want to be perceived as political, trying to help one party over another. So there's a bit of a caveat to that assumption. But generally speaking, the economy is definitely slowing down nationally. There's some regions where they're still doing pretty good, or pockets. To your point, you mentioned this renaissance of the AI data centers, and there are pockets of the economy where the economy is humming. But when you look at the cyclical part of the economy, manufacturing, parts that they definitely have a huge effect in the marginal growth of the economy. So we're basically excluding the parts that are not cyclical, like education, healthcare. that doesn't matter what the economy is doing. Those are essential services. So if you just strip that part of the economy out and focus on the true cyclicality part of the economy, you can clearly see that the economy is definitely decelerating because, let's face it, the monetary policy, it is very, very tight given these current rates that we're seeing. So we're big believers on the inflation moderating, and therefore we have positioned your portfolio to benefit from that trend. And what does that mean? That means rates should start to moderately head lower, and therefore we've increased the sensitivity because of that assumption. So if rates are going to go lower from the current levels of 4.5% 10-year, your portfolio is actually sitting at a pretty good spot to have a pretty good total return going forward.
You and I were talking out there a little while ago.
Yes.
Give them a sense of how the portfolio environment, the bond market environment, it's changed, how it has changed over the last, let's say, 11, 12 years. You can talk about coupon and things like that. Going forward versus what we've seen in the past, what's your expectation on how bonds will benefit this pension plan?
It will definitely benefit. Used to be, the bond market was your anchor, right? To provide that diversification benefit, especially when you have, a rising probability of a recession. You would probably see some kind of elevated volatility on risk assets like stocks, but then you can count on the bond part to maintain your total, risk management for the portfolio. In the past, because of, the quantitative easing 1, 2, 3, all these policies that really derived as a result of the great financial crisis that we went to in 2008, we had this strategic shift from a free market-based economy to a central planning, levered economy, basically central bank driving everything, right? So central bank announced these series of quantitative easings, a zero rate policy for a long, long period of time. And the side effect of that is that, for at least on the bond market, we had this anemic yield environment for over a decade.
It was
So
a drag.
It was a huge drag to your total return.
A lot.
It was basically an indirect financial repression environment, but the stocks did benefit because of the low cost of funding, and that really propelled the valuations and everything that you can think of on the equity side. So you did really benefit on the equity side, but from the bond part of the equation, it was a pretty anemic period in terms of total return. Now going forward, as a bond manager, I'm pretty excited to see a 5% yield in the highest quality asset class that you have in your portfolio. First of all, you get two benefits. I mentioned the diversification benefit from a total risk management standpoint, but now you're actually getting paid. You're getting paid to wait to manage the risk. A 5% yield in a 2% inflationary environment, that means you're getting a 3% real yield. That is an historic discount that you get with bonds, which normally you don't usually get that type of rates.
So that leads to, why don't you leverage that we talked about this earlier, and you can go into more granular detail. Why wouldn't you increase the duration or certainly try to make these great times last longer? And maybe you're already doing that.
And we have already done that. So we have increased the duration, the effective duration, because we have an overweight to mortgages. Mortgages is kind of hard to quantify the duration, which is the measure of sensitivity to moves in rates. With a simple bond like a treasury or a corporate bond, you know exactly what the duration is. With mortgages, it's a little bit more of a fuzzy math because there's a lot of uncertainty on the model, the prepayment patterns, and that makes the duration a little bit more uncertain. But generally speaking, recently we have increased the duration because of our view that rates have peaked in terms of the nominal levels. Inflation is moderating, and therefore, and the economy is slowing down. Therefore, it makes sense to increase the duration, and we have a higher sensitivity of your portfolio versus the market. So in other words, if rates are going to go down from the current levels, you should benefit going forward. One more thing we've done is, and it's also not just rates are going down, but which rates are going down. See, that's like the second order of thinking. Typically, when the Fed starts cutting rates, not all the maturities move at the same kind of parallel pattern. Typically, the shorter term maturities tend to outperform. They move significantly lower and you have that normalization of the difference between long dated maturities and short dated maturities. So that is another lever that we have positioned your portfolio to benefit from that normalization, because currently it's inverted, it's upside down. And normally that happens only 10% of the time over the last 80 plus years. So you're going to benefit from a lower rate environment and from a normalization of that difference. And then finally, from a sector allocation, because of our view that we might potentially see an increased probability of recession, we have decreased the exposure to credit risk, corporate bonds, because of they're very rich right now, richly valued versus everything else. They're kind of correlated with equity asset class, with stocks. So stocks are trading at all-time high. VIX, the volatility is basically low. There's just this complacency. Everybody's going in for this, this all-in yield, and the end result of that is we're seeing these record rich valuations in the credit market. So what we've done is we've actually reduced the weight on the credit side, and we've swapped that into the mortgages.
Look at page 17. Maybe
Yes.
you can, is this the way it looks right now, or is this dated?
The page
17 in your book,
Yes.
maturity distribution.
So this is the maturity. Yes, it is right now. But the more important part is look at the page before that, which is
Okay.
the duration distribution, right? Because the maturity and duration, sometimes it's a little bit
Yeah,
off.
sure, that's better. Okay.
So the best sensitivity to look at is actually the duration. So this is exactly what I'm talking about. You see that huge tower in the middle? That is your portfolio. So what we're saying here is that in a normalizing environment, when the short maturities start yielding less than the long dated maturities, that's what we call the normal environment. Because you expect that as an investor, right? If I'm going to be investing for a 30-year horizon, I want to get compensated for the uncertainty. I don't know if you're going to have inflation 10 years from now. So therefore, it's normal to expect a higher yielding maturity versus, say, a 2-year, because with 2 years, you have a much better visibility of what's going to happen in the next 2 years. So that is the normal expected environment. So as we get to that environment of rates, your portfolio is actually going to benefit versus the market in a big way, just because how we're positioned currently, in addition to the higher sensitivity of rates. And then finally, one page ahead of that, you could see the current characteristics. I talked about the 5% yield, so you can see the yield in your portfolio, and the fact that we have this and the sector allocation at the bottom half of that page. You would notice that we have an overweight in mortgages, and that is by design, because we like that the relative value prospects of that asset class. Normally, mortgages, it's almost like a no free lunch, because you have no credit risk. It's government guaranteed, and it's backed by the asset class, the underlying homes. The problem there is you always have this prepayment risk, right? We all have mortgages. Typically, when you have a rally in rates, we all call our buddy, our loan officer, and say, "Hey, I want to refinance my mortgage." Well, that's not a free lunch, because somebody's going to lose on that equation. And typically, who loses? It's actually the holder, the creditor of that mortgage-backed securities. But in this case, because rates have increased so much, a lot of this legacy production in the mortgage asset class is trading at 85 cents, 90 cents on the dollar. Okay. So the prepayment risk is very minimal. You actually want them to repay, you want them to refinance, or you want them to sell the house or move or get a job. So when you move, you essentially sell your house, and that loan gets put back to the trust at par. So you have that extra capital gain now, which is it's a perverse way of thinking. So from a prepayment risk, we're very confident that it's very minimal at this level, because of the discount in prices and the fact that you have no credit risk, and you get a similar carry relative to corporate bonds. It really makes sense for us from a risk reward standpoint to be overweight mortgages and underweight credit risk. So that is the third lever of us being active relative to the market. So one more page I wanted to share with you, and this is something that not many folks talk about, but here, it's another fact that really assures us on our view that the inflation is going to be moderating, and that's page 31. And this is kind of putting the monetarist hat on. Not many folks talks about the money supply, but generally speaking, based on the long-term studies, to get to that 2% inflation target that the Fed has been, basically pursuing for many decades, you essentially need a 6% growth, constant growth of money supply given our real output potential, growth potential, and the velocity of our liquidity in the system. So you need that 6% growth. And funny enough, back in 2020, when we got the COVID and that emergency response, everybody, the Fed started printing money and we had this huge increase in fiscal debt. You would notice that the supply of money increased by a rate of close to 30%. That is completely unprecedented. It's never happened before. And funny enough is if you divide that by 3, you get to that 9% CPI. And that is exactly, we actually breached the 9% CPI. And then we've been basically normalizing since that high. But what you would notice recently is actually now we actually have a shrinking money supply, not a reduced rate of growth, but actually a nominal shrinking of money supply in the last year and a half. So if you give it enough time, because these things operate with the lagged effect, a year and a half, 2 years into it, enough time to make its way into the real channels of our economy, this is another strong supporting argument that inflation is going to be moderating, and potentially we might be talking about deflation at a near point. The only reason why we haven't talked about deflation yet is because we still have this crazy fiscal policy that keeps, enabling these new programs, and we're trying to basically defer, the eventuality of facing a severe slowdown in the economy. So here's a very strong argument that not many folks talk about, but this is taking the monetarist head on and supporting our fact that our belief that the inflation is going to be moderating, and then having a high quality asset class like the core portfolio that you have. It's a great idea right now, especially given the carry that you get right now with a 5% yield. So with that, I'll conclude my brief presentation, and I'll take any questions if you have any additional questions.
Motion, we accept the Sawgrass report as presented. Second.
The move that we accept the Sawgrass report as presented. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Capital City Treasury.
Thank you.
Okay, good morning. Dwayne Madron, Capital City Trust in Tallahassee. Page down, Jill, please. To the policy review. Currently, we're holding 6% in cash, which is kind of high because we're a little bit underweight in equities and underweight in bonds. Cash is yielding 5.3%. And it's there because of being a placeholder, and at earning 5.3, there's very little risk. It's more of some dry powder in case we get a pullback, and also it's an attractive yield. So if you look, international is underweight. The policy percentage 6.2 versus 8 because growth in the U.S. is simply better than many countries overseas. Bonds are underweight because of the uncertainty in the direction of interest rates. We've seen them go up and go down depending on what month you're looking at. Eventually rates will come down, we hope. The rest of the portfolio, convertible bonds is a little bit overweight because it has an equity component in it, but it is less risky than equities. So a little bit exposure to equities there with less risk. But in general, we're overweight in equities about as much as we can be because the economy is decent. It's growing. Unemployment is low, and things are getting better. We're probably going to avoid a recession. We are not assuming that there is a recession is going to happen. Having said that, let me page down to the performance. For the first quarter, the year-to-date is the fiscal year-to-date, up 18.76, which is outstanding. That stocks have returned 21% the fiscal year-to-date. A little bit behind the S&P 500 because of small cap, mid cap, and international. High yield bonds 7.5% versus the Bloomberg aggregate of 5.9. So High yield bonds did their job by acting like an equity when equities go up. So let me just talk a little bit about what happened and then why it happened. So the first quarter, equities were up 10.56%. And that was one half of that came from NVIDIA, Facebook, Amazon, and Microsoft. So one half of the stock market's return came from 4 companies. In addition, artificial intelligence, which is a growth theme, is building out its infrastructure so it can eventually make money. And by doing so, it has attracted a lot of capital and interest in the technology sector, especially semiconductors. So that also helped push stocks up because of the excitement about artificial intelligence. In addition, and this is really something I like, is that 383 stocks had a positive return in the first quarter. That shows increased breadth. And that's what we want. We don't want the stock market to be concentrated in 5 or 6 stocks. We want everybody participating. Small cap and mid cap are starting to perk up and earn close to what large cap is earning. U.S. stocks beat non-U.S. stocks because of the strong dollar, but also if you take the dollar equation out of it, it's almost the same as the U.S., but still the growth here and the companies here in the U.S. stock market are pretty darn good. So that's what happened. Why did it happen? Earnings growth was steady in the low double digits in the first quarter. Many companies expanded their profit margins. Inflation came down a little bit. Consumer spending was strong. Unemployment was still low. And there was an increased confidence that we're going to avoid a recession. So investors were excited, exuberant, maybe. Stocks went up more than they should have because earnings didn't reflect that. That's what we call PE expansion. So stocks got ahead of themselves. Nevertheless, we'll take it. The downside going forward is that growth is slowing. GDP growth was only 1.3% in the first quarter, which is not great. Stock valuations are very high, and that's why you see the stock market slowing down. And there's still uncertainty regarding when the Fed will lower interest rates because certain parts of the economy are doing quite well, and that kind of scares inflation a little bit. But in general, the economy is slowing down. And so if you want to page down to the next slide, we can look at April returns through April. April was not a good month. It pulled back a little bit. So the year to date is only 14.3, and stocks, year to date are 15.98 because in April was down about 3. May is up a little bit. But long term, over the last 5 years, 9.39 per year for equities. Most of that coming from stocks, less of it coming from the high yield bonds. But long-term returns have been good on the equity side because of what Sawgrass was talking about, lower rates pushing equities up, but bonds suffered at the expense of that, but equities made up and did a good job holding up the fund. Going forward, like Sawgrass said, equities are still an excellent diversifier. Bonds are still an excellent diversifier of equity risk, and especially since they're yielding close to 5. And any questions so far? Page down to the asset allocation. So this is a Capital City Trust, not including the infrastructure or the private real estate. And you see 70% in equity. The part we manage $11,675,560. And if you page down, you can see the index funds. Many of the funds we use are low-cost index funds that have almost no fee. There's 1 or 2 active managers, but this keeps the cost down and gives you adequate diversification over all parts of the policy. And so it's very cost-effective and simple to understand. That concludes my comments. Any questions?
No questions? Is there a motion?
I'll make that motion to accept the report as reported on.
Second.
Been moved and second that we accept the Capital City Trust report. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries.
Thank you.
Report. Tell us how we're doing.
Well, I'll tell you, fiscal year to date, you're doing very well. I think, you, Dwayne, may have already indicated that, but I'll show you in our report. Turn to page. Page 7. Fiscal year to date net. So this is the first 2 quarters of your fiscal year, 14.7%. We saw a little bit of a pullback about 4 weeks ago, and then we saw things kind of recover. So I'm going to just take a stab and say you're about you're probably right around the same number, around 15% fiscal year to date. So if we just put everything on ice from here until the end of the fiscal year and end of September, I'm thinking you're going to have a double-digit return. This will make Patrick very happy. Patrick on the line? He's. I just saw him asleep.
No, I'm here.
So Patrick, we got
That's
fiscal.
wonderful, Burgess.
Yeah, 15%. What do you think, buddy?
That's awesome. That would be so wonderful if we could end the year like that.
Yeah. Okay.
That would help and maybe bump up the multiplier for the police officers too.
Yeah. So before I get into the report, I just wanted to remind you of what we did last year when the House Bill 3 language had to be incorporated in the investment policy. We made some changes, and the big picture is we downshifted the allocation to from international, from convertibles, we eliminated the REIT completely. We downshifted 2% from the private real estate, and we pushed 2% more into bonds, from 18 to 20% on the target for the core bonds. And then for the large cap S&P 500, we stepped that up from 25% to 40%. So we still have a very strong, favorable view towards U.S. equities versus foreign stocks. And I think so far, this has played out well for you guys. So I'll skip page 1. Look at that another time if you want. Takeaway there is that international stocks remain cheap, but we think that they're cheap for a reason. Better prospects in the U.S. On page 4, summary remarks. Very strong quarter. 650,000 was earned, 5.2 net. A little bit behind the model, not much. Now, Dwayne is carrying a considerable amount of cash right now. And he remarked a few minutes ago why he likes making that 5.4% annual return on that cash. It's pretty good. Ranking is very impressive, top quartile. So where'd you make the money? You made it, first of all, the top performer was the S&P 500. That's the Vanguard Institutional Index, followed by mid-cap and Euro-Pacific. So within those first 2, the big drivers were growth, technology. And for the 1 year, the 13.5 net, 1.6 million. I wouldn't be surprised if we end up somewhere in that neighborhood for this fiscal year, maybe a little better. There's the leader again. And remember, you've increased the allocation by 15%. We went up to 40% from 25. So think about it. You put a big slug of money into the best performing category. So the timing there was pretty good.
Thanks for the recommendation.
You're welcome. Sometimes there's no wisdom here. A lot of it's just luck. Sometimes you get it right, sometimes you don't. The 3-year average is not that impressive because 2022 is embedded there, that horrific year. But the 5-year number, I think, represents really what to expect going forward, somewhere around 7.4% net. Is that where we are, Patrick, now, 7.4?
I believe so. Let me check real quick.
So anyway, if that's the case, it's pretty good. 10-year average, 6.5%. I should mention FRS, Florida Retirement System. They're using a 6.7% average expected return. So you're
We're at 7.5, Burgess.
7.5. Okay.
Yes.
And is there a step down going on per year, or is that discussed every year?
Give me one more second and I'll check that.
Let's see. You can see the numbers on page 7. 10 years ago, you were just under $10 million. About 7.3 million represents the inflows from the chapter monies from the city and payroll deduction, minus expenses. So that's that 4.3 million negative. That's the net flows over the last 10 years. More money's going out than has come in. But the good news
Burgess,
is
we just voted to keep it at 7.5 right now.
7.5. Okay. But you earned roughly almost twice as much as you spent net outflow over the last 10 years. So that's pretty healthy. Any questions about the report? I don't see any changes that I'd recommend at this time. I think Dwayne's doing an outstanding job. He's keeping the expenses way down. That's why, 65% of this is in indexes, and they've done very well for you.
Motion to accept the Burgess Chambers report is presented.
Second.
Is there any discussion? All in favor?
Aye.
All opposed? Motion carried. Foster, Patrick. Guess I need to turn my mic on. Foster, Patrick.
I think there was 2 items on the agenda, of which was Chapter 185 monies, and one of which is the part that Jill is highlighting right now on the screen. But as far as the use of the state monies and the fluctuating multiplier and all that, I think we talked about it quite a bit at the last couple meetings. And I think the plan is to have a workshop with the employees and with the city commissioners down the road. So I don't know if we really need to talk about that today, but I'd be happy to talk about it if somebody wants to.
Just other than determining a time. Oh, yes, sir. Other than just determining a time to schedule the workshop, I don't have any questions.
I discussed at the last meeting that right now the commissioners are very much over their heads in workshops, primarily due to the budget. So for the next, until they get the budget settled, which has to be settled by October 1st, I would recommend against trying to get their attention. However, you know, after October 1st, when the budget is settled and they have more opportunities for workshops, the goal is to get the employees, the retirees, and the commissioners all up to speed on what we've been talking about for the last 2 or 3 meetings at that workshop.
Jill, would this be a joint meeting with the other, or no, I'm sorry, this is 185 monies, I'm sorry.
Well, it would be a joint meeting because both the
Us and fire.
fire
Okay.
and the police get the state monies, and you're both struggling with the same issues. The general pension has already passed that they're getting a 4%, all retirees are getting a 4% increase. But they don't deal with state monies. So that's already been passed by the commission and is done. So it's really the police and the fire, and you might have different takes on how to deal with the issue. And that, but the general people coming to that meeting need to understand what the issues are from both of your perspectives, even though you might have different ways of solving it.
So should we look at, and I don't know if anyone from the fire pension board mentioned this or not, but should we look at having a meeting between police and fire with Patrick to where we can discuss our options and get all of us on the same, kind of on the same wavelength, for lack of a better term?
Level of understanding.
Yes,
Yeah.
sir. Exactly.
Yeah.
Before we involve the commission, not trying to exclude the commission from anything, but just so that the 2 boards have an understanding, because I'm not sure that we're in total understanding of what we can and can't do at this point. Just speaking for myself, not speaking for the fire or speaking for our other.
It's
board
really
members
up
here.
to you, you know, if you want to have your, you can always contact another board directly. There's no sunshine issue with that. Or you could have our chairperson contact their chairperson if you wanted to set up a joint workshop just for state monies, and just say, you know, this is going to involve both boards just to understand what we're both dealing with. I'm sure that could be arranged too, but getting the commission's attention is going to be difficult until that budget is gone through.
And I think it gives us an opportunity to kind of work out all the, I guess, the different nuances that, and be able to make a better presentation
Yes,
to the
sir.
commission. And that way, everybody will have a better understanding if the fire and police department got together and did a joint workshop. Because I don't think it's prudent to do a separate workshop and go over the same thing over again. I think it's not the best use of Patrick's time if we did that. So.
Right. Yeah,
It's going to be difficult to get the commission up to speed in one meeting, when it's taken the boards, you know, like 3-4 meetings, workshop, to even really totally understand the issue. But perhaps if we had a workshop where everybody was, police and fire were on board, that you could narrow down your options.
Jill, is this something that? if
Well, hey,
you
I
did-
just was thinking, I was looking at when we did the evaluation last year, and we actually produced it February 13th. Board doesn't meet until, do they meet early March, or what do they meet?
Which board? The commission?
Well, I think all 3 boards meet together or at the same day.
Yeah, they
It's
met.
usually early March.
Yes, that the February 27th meeting was the March meeting. And then,
Okay, so, maybe on that day, kind of like we did the luncheon at the other meeting. Maybe we should do it then, since nothing's gonna happen for a little while. And it's aren't changing October 1, 2024. Maybe I'll be there already for that February 27th, early March meeting next year. And we could do the same thing where we have a lunch and it's just police and fire. And we talk about this whole issue and how we want to present it to the members and to the commission. That probably sounds like the most efficient way to do it.
Yeah, but do we want to wait 9 months to do that? To get fire and police pension board members on the,
Well, what would have to happen is something would have to happen before October 2025. Nothing's going to happen before October 1, 2024. And then that would actually have the results of the valuation so we could see what actually is projected to happen with multiplier next year. So, I mean, if we could have a joint workshop for the police and the fire in September or October or something, but we won't know the impact of like the investment return that happens this year and what that's going to do to the state monies. So it may just make sense to wait, since nothing is going to change between October 1, 2024 and October 1, 2025. I think it's just a thought, but I can certainly come up for a workshop before then.
This is out of my wheelhouse, but I think there's a sense of they don't want to waste a lot of time in thinking about this. This 6 months goes by and then another 6 months. Maybe you could do an earlier workshop. I know you're waiting for the returns for the year, but you could, right now we're at 15% fiscal year to date. You could have a table that shows 10%, a 15%, different outcomes, and whatever the outcome is, it is what it is. But in the meantime, they can get a better understanding of the issues sooner.
I think the best thing for us to do, in my opinion, would be for us and fire to kind of come to some sort of, maybe not a total consensus, but to have an idea before we go present to the commission, because we don't want to waste their whole day. If we're sitting there all willy-nilly going back and forth, going, we want this, you want this, this is how we're going to do it, and we don't come up with something during that meeting, it's a wasted meeting for the commission.
but the commission, a workshop is not where they make decisions. They don't vote in
Well, I
workshops.
understand that.
So
But we don't want to waste the entire day for a workshop and have nowhere near where we're even ready
Conclusions.
for a decision afterwards.
Yeah.
If we had a couple, like he said, a couple of ideas going in that we're looking at this one or this one, us and fire talk about it, and then we present that in the workshop, we've limited everything. There's a good possibility we come up with a consensus by the end of the workshop, and we're done with it. We don't have to carry it on for another day. I kind of see what he's trying to say there, I think.
So 2 workshops, one for police and fire only, and then one where you present your ideas to the commission.
And I wouldn't even say he has to be present for the workshop. I mean, we could do it on Zoom. I mean, I think as long as we have his
Input.
buyback and his say so, and tell us what we're looking at. I mean, I wouldn't think he would have to be present for that.
hey, Patrick, do we have to have a consensus with the fire pension board? Meaning, do we have to do the same thing, or do they have to do the same thing that we do with the 185 monies?
No. They're-
Yeah.
Well, like Jill said, you guys are completely separate, but you have the exact same issue where, your ordinance says that every year we evaluate the state monies and determine how much the multiplier should be. So if there's going to be a change, it seems like it would make logical sense for both of you guys to have the same approach, but you wouldn't have to. But the other thing is that, if we did a joint workshop, my expenses would be split between you guys, and it would just be more efficient probably to have a joint workshop or a joint board meeting between the police and fire pension boards. That's not a bad idea. So you guys are all, understand it well before we put in front of the members in the commission. That does make sense. And I can work with any time, September, October, whatever you guys want.
Late.
Would it be possible to overlap the two board meetings, fire and police? And during that overlap, maybe do that where it's still part of the meeting, but it's each of us cut off like 20 minutes early.
When is the September meeting, Joe?
Yeah.
It's late August. I think it's August 27th. Exactly.
And that way we would come in during the end of their meeting.
Yeah.
And we would discuss all this, and then we would proceed with our meeting right after that. So we're not doing any special trips or.
Yeah, they end at 11:30, basically an hour and a half, and you normally wouldn't start till 1 o'clock. So you'd have between 11:30 and 1 o'clock for that joint meeting,
What time does the fire department get started with their meeting?
10 o'clock.
Okay, that sounds right. In fact, if we're going to do a joint workshop, I think starting the workshop itself at 11 and
That
probably
only
give it
gives
to
them
1,
an hour for their meeting.
right?
Okay.
And
Yeah,
it gives,
and we would do the same thing.
Thank
We would only have an hour for our meeting, but we would give up the half hour for our joint workshops.
Okay.
but also one thing too is I think what I would like to make sure that we've done is have all the projections in, have all the different scenarios in, have all the information so that when we do meet with the commission, that they will have a good understanding of what we're asking for, and they need to understand what their contribution is going to, because that's basically what they're going to be concerned about. And we got to make that clear. So if it's not a burdensome on the city and that kind of thing, they will probably be more apt to make a recommendation to go take it to the commission to vote on, probably at their next meeting. So, but if we don't have all that information, and if we don't have all the different scenarios and that kind of thing, and leave that meeting with them, we're going to probably end up having 2 or 3 other meetings and that kind of thing as well, and then waiting to get on this commission calendar again.
The only concern is you're making a decision and it's going to change. If you did this workshop in August, it will not change anything until it's past the commission, which is in the next budget year. So the changes will not happen till October 2025 for the 2026 fiscal year.
Right.
So you're making a decision in, say, November. The commission would make that decision. It wouldn't be implemented till the next
Right.
October.
Right, because
Right.
they have to build it into the budget. whatever the changes
Exactly,
are.
yes.
So that was gonna be my next thing.
Patrick, do you think it would be beneficial for police to do a similar study that fire completed on fixing the multiplier? Because we're talking about trying to get the 2 boards on the same page, but right now the 2 boards are not.
Yeah, we certainly could. Then you'll have some numbers, concrete numbers to go off of for that scenario. I did want to point out is that, you mentioned having the exact numbers so that the city knows the impact on their funding requirements. And that's fine, except that what we're really talking about here is a structure change, right? So right now, if the market goes down, everybody's multiplier goes down. If we changed it to just have a fixed multiplier that doesn't fluctuate, then if the market goes down, the city's costs are gonna go up. So none of this really affects their current funding requirements. It's all kind of theoretical as to what would happen in the future. But it's still an understanding that everybody needs to have an understanding of what changes would impact, how they would impact the members and how they would impact the city. But I can't give you exactly the impact that it's going to be 2 years from now if they decide to change their structure. You see what I'm saying?
That's why you were advocating waiting until the valuation report came out.
Well, I was, but really, I think based on the fire meeting we had earlier, I think that, this is a very complicated subject. And I don't think even the fire board completely understands what's going on. And I don't think the police board completely understands. So having a joint meeting in September where we can hash it out some more, and we can do the study for the police of increasing the multiplier by 0.1 and have that for that meeting. And that way the boards can understand the current structure and possible changes. Remember, we're talking about possibly changing the ordinance and how we structure the benefit multiplier. And if we have a share plan or we don't have a share plan, all those things are things that are going to affect the future, not necessarily the immediate, but we all need to understand it before we present it to the city commission and the membership. So I think it would be productive to have a joint meeting in September in between the two meetings where the police and the fire can just talk about this one issue.
But I also think that the city manager probably needs to be a part of this workshop that the fire department and the police department is going to have, just so that he can be enlightened and probably help the commission understand better what we're trying to do as well.
Yeah, I agree, because when it comes before the commission, when the commission asks questions, they're gonna ask him and the finance director.
Mhm.
So we probably should even have Ms. Carty in that meeting as well.
Mhm.
Is this something that we need to make a motion on, or is this something that we just contact the fire board on?
We have staff to contact the fire department. I don't think that we actually need to make a motion on this. But I guess we can make a motion to actually do the actual workshop though.
My understanding that's the timing is probably not good for the city manager or the finance director until we get closer to October 1 and they finish out their budget process.
So there will be a meeting in December as
So
well.
a workshop would be productive. They just might be harder to get in August if you tried to overlap your two meetings.
So let's put the workshop off until December then, because it just makes sense to have them in this meeting. Because, the city manager is able to talk to the commission one-on-one and to have those individual meetings with them to help them understand.
Yes.
Prior to us having that workshop with the commission. So they'll come in with some idea of what we're trying to accomplish.
I agree. I think we should do it in December, and it does give Mr. Bell and Ms. Carty more planning time and opportunity to participate in this. So maybe we could look at doing that.
Well, then I might want to go back to my original comment and say, if you're going to wait till December, maybe we should wait till March, because then we'll have the valuation done. We'll know the impact on state monies. And we still have 6 months, to get something done before October 1st, 2025.
I think
Just a thought.
my only concern on waiting until March is as a municipality, we are right back where we are now almost we're already doing budget workshops with our commission. we're
right back to
doing
that.
multiple meetings with department heads and assistant department heads. The finance department is extremely busy March,
Yeah,
April,
that's
May.
fine then. Yeah, that's no
So-
problem. We can just do it in December. And then when I come in March, everybody will kind of already understand what's going on. So that's perfectly fine.
Would you want to consider an October special meeting? And then if you had further things to work out or discuss, you could use December for that purpose?
We can do our meeting in August or September or August, whichever it is, with the joint, and I think we can get an idea. I think we'll have an idea after that meeting, so we'll be able to go to him in the March meeting. And we'll be able to set something.
But I think I think Jill's point is that when in August, we're still going to be dealing with several workshops.
Yes, they're
Right.
not finalized on their
No,
budget and
we
they,
won't- we
yeah,
won't need- We're
them.
not gonna be able to have them in here.
Yeah.
But this is more
But-
fact finding.
but this
more
is
than anything
also-
else. This is just for us and fire department to go, these are our options, this is what's best for us, this is what's best for them. And then discussing that to see if maybe we can come up with something better, or if they have something better. And
But
then
if
we
you want-
present it to the commission.
But if you want the city manager and the finance director involved in the August workshop, that's
gonna be
where the
hard.
rub
I know,
comes
I-
in.
I
It's
understand.
better for, not the commission, but for the sake of the city manager and finance director, it'd be better in December.
Right, I thought, yeah,
Yeah.
I'm sorry, I thought we
Yeah.
did that, but for some reason we got back to August.
Yeah.
But
Yeah, no, I think honestly, I think to me, the best time to do it is in December, to be able to have the joint meeting with just fire and police. It gives staff an opportunity and plenty of time to plan it ahead, as well as to have the city manager and the finance director involved in December. What do you think, Mr. Norwood?
It's December 3rd. I'll put it on my calendar.
Sounds good to me. So, is there a motion to that effect?
motion to have a joint meeting with fire department on December 3rd to conduct a workshop for pension 185 monies.
Second.
Been moved and second that we have a workshop with the fire department on December the 3rd. So that we can start preparing to make a recommendation to the commission. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries.
Can I ask one other thing then?
Yeah, wait, Patrick.
So the fire board had me do a study of, because one of the scenarios would be to just fix the multiplier where it is, and not have it fluctuate anymore for active employees or retirees. But now that it's been kind of reduced, they wanted to see what if we increased it by 0.1%. Jill's putting it on the screen now. So if we, would you like me to do that study so that we have it for the December joint meeting?
Yes, sir.
Please.
That'll take a vote as well.
Yes,
because-
let's go ahead
Okay.
and make a motion to that effect
Motion for the study on 185 monies
for the police department,
for the police department.
for the police pension fund.
Second.
Been second by Al, second. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Patrick, anything else?
Oh, I think Joe's got one other issue I'll stick on for. So this issue is basically, the multiplier does change, as you guys are well aware. And so these two members here, Cornell Brown and Thomas Tipton, they went into the drop, and their benefit was, say, $1,000 a month. But during the time they were in the drop, the multiplier reduced. So it might have went from $1,000 to $980. Well, then when they left the drop, the city or the board or whoever kept paying them the $1,000 instead of what should have been $980. So that's the issue that happened with these two members. And the total is not, very significant. The total overpayment for Brown was $377 and the total overpayment for Tipton was $647. But they were overpaid and that should be recovered. And I don't know if you guys want to do like recover it over a 3-year period or just one time or what you guys wanted to do with that.
And this was a clerical error on our part.
Yes, yes.
I just want to make sure I understand.
Yeah, the pension administrator at that time didn't put it in the files. And so when they actually left drop, didn't realize the changes and it was caught. Now it's been a couple of years that each have been retired. It was caught by the actuary. And
Have they been made aware of the overage?
they have not been made aware of the overage. I was waiting to hear from the board how you wanted to deal with it, whether you wanted to say the board will take care of it, or do you want us to go back to them and explain it and try and make a payment plan? Given the amounts of the overpayment, it's really up to you.
Is the attorney on?
Yes, she is. Anna is here.
I mean, it's such a nominal amount and it's our mistake. I almost want to go, let's call it a wash and make sure they
Yeah,
understand that their rate is now this.
Yes.
Anna, can we legally do that? Can we wash this, meaning that
You
we don't
can.
expect to-
You can, especially if, if I were to be involved in contacting them, since it is such a nominal amount, it might cost more realistically for me to contact them to try to, recoup the amount, that you would really be potentially saving the fund money by just, kind of letting this one go. Again, completely up to you. You're well within your authority to try to recoup, to fix the overpayment. But again, given the amount, my recommendation would be that it would be, completely reasonable to let this one go.
So no legal ramifications on the board, no moral or ethical related decisions if a motion was to be made to.
That's correct.
Okay.
I think just the nominal amount we're talking about, the fact that it was our mistake in the first place. I mean, if we were talking $10,000, obviously I would feel a little differently. But we're talking about $1,000 total between the two of them. Our mistake, like she said, it'll probably cost us more for her involvement. I think we eat that.
Their motion?
What would the motion need to be, Jill?
Motion that we go ahead and just accept the fact that we've taken a loss of $377.16 for Cornell Brown and $647.50 for Thomas Tipton, where they were overpaid through their drop in retirement accounts.
Is that your motion?
That's my motion.
Second.
It's really a motion that we will accept the overpayment of Cornell Brown and Mr. Tipton. Is there any more discussion? All in favor? All opposed? Motion carries.
Jill, just to confirm, they are getting paid the right amounts now, correct?
Yes, because of the last 2 years when the actuary went and increased their payment and then decreased the payment, that's what triggered him finding it. So yes, they're getting paid correctly now.
Yes.
Now, do they know that there was a change?
No.
No,
You don't do, and just a question as a retiree, somebody in the drop, I get a notice every time so far that there's been a change. in the 185 monies or whatever, where my pension.
Yes,
drops. Do
yes,
they get something similar? that's-
yes.
Okay, that's all.
Yep, the actuary creates something and I make a letter to them explaining the increase or decrease.
Sounds perfect.
Okay. Anything else? Patrick? Ms. Sheila, anything else?
We have to go on to, Clauser and Cough.
Right.
but
I'm gonna
no,
say anything else from the
No.
actuary?
No,
Okay. Let's then take up item 7, Clauser and Hoffman and Jensen, Livingston. Adam? Sorry, it's not Adam.
That's okay. It's Anna on. Adam covered for me last time. So I'm sure Jill provided you with just a short disability memo. There was a change from the IRS in instructions on how to report disability annuity payments for first responders. So depending on how the disability is calculated will depend on whether it's taxable or not. So essentially, if any part of the pension benefit is based on age or length of service, that amount gets put into a specific box on a 1099-R. So to help out with this, moving forward, any disability final orders will have a paragraph at the end saying how the benefit is calculated, whether it's just a flat 50%, final average salary, or whether it's based on age or years of service, that will be listed to help the member, with their filings. Again, we're not giving legal or tax advice, but just want to help point them in the right direction if we can do that.
Any action on our part?
No, just an informational, just going forward. And if and when there is a disability, we would work with the administrator just to make sure that we have all the correct information regarding how that benefit's calculated.
Resource Centers contract?
Yes, so these are ready for signature. I believe, Jill has passed it out to the board. We had only one small change from Patrick's proposed agreement. It was regarding the contact person for public records request. So, on our end, we're satisfied with the agreement and we recommend that it be signed today. Unless there are any questions, we should be ready to move forward.
Is there a motion to accept the contract and to authorize the chair to sign?
Make a motion to accept the contract and to authorize the chair to sign it.
Seconded.
Is there any discussion? All in favor?
Aye.
All opposed? Motion carries.
Great, thank you. And if Jill, you could either send it to me or directly to Resource Center, and then we can go from there.
okay, thank you.
Okay, item 8, quarterly expenditures. Jill?
Yes. Quarterly expenditures up on the screen. There. Nothing out of the ordinary. Bounce check. That's it.
Is there a motion to accept these, to pay these expenditures?
Make a motion we're accepting the report, correct?
That's correct.
Yeah, motion to accept the report as presented.
Okay.
Seconded.
It's been moved that we accept the report as presented. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Item 9, budget for fiscal year 2025.
You can see that I've bumped some of the fees, Foster and Foster, things like they had a new fee schedule come into effect this fiscal year. There's the Resource Center pension administration costs in it. And there's enough schooling money for 3 trustees to go to 1 conference. So the idea is a trustee goes every other year to a conference.
Okay. Let's see. What's the percentage of increase in the budget?
Yes, I can. Here is the budget from last year, right here on the expenses. So it's 58 for investment, almost 59 for investment expenses, and 54 for admin expenses. Here it's 54.6 for investment fees and 64.
Okay.
Hey, Joe,
Yes.
Joe,
Yes.
because of these, we actually, if you look at that other thing, we were at 30,000 last year and 24,000 for this coming year. And I
Last year,
think because we have those multiple,
go ahead.
because we have the multiple workshops possibility, I think we should keep it at 30. It doesn't mean we'll spend all that, but at least you won't have to amend the budget.
Yes, last year, the budget was high because some of the expenses from the prior year flowed into that year, that they weren't expensed. They weren't received in time to be expensed in the proper year. But if you'd like those numbers to increase, I can see why you're thinking that way with the increase in studies and the increase in responsibilities as far as attending workshops.
Okay. So that means, well, I guess prior to taking a vote, we can actually go ahead and make the adjustment. That way we want to do an amendment. So are we suggesting that the 24,000 be moved to 30,000 in the budget
Correct.
Yes.
for Foster and Foster? Okay. So with that change, is there a motion to accept the budget?
I motion that we accept the budget with the amended changes that we just discussed.
It's been moved and second that we accept the budget with the amendment. We changing the $24,000 for Foster and Foster to $30,000. Is there any discussion? All in favor?
Aye.
All opposed? Motion carries. Is there any public comments at this time? Just so you know, it's not reasonable to expect a response from this board on any public comments since we have not heard, had an opportunity to investigate whatever you may be discussing, but we will hear from the public if you deem necessary. No public comments? Is there other business in the meeting dates?
We wanted to make a recommendation that the board begin to update signature authorizations on file with your next meeting at the end of August. The city is in the process of still hiring a replacement for Jill, and we would expect that person might be included on your signature authorizations. So we would hold it pending those further updates, but we would like to begin that process now. So we were asking for a motion to update your signature authorizations for both Capital City and other investment managers so that we can begin to step in.
All right, the chair will entertain a motion to update the signatures so that it will reflect the new management that the pension board has now approved. Looking for another word. That's okay. That has approved. Is there a motion for that effect?
Yeah, I make the motion that what you just said.
Is there a second?
Second.
It's been moved and second that we authorize signature changes so that the new management company will have access to managing this pension fund. Is there any discussion? All in favor? All opposed? Motion carries. Is there anything else?
Just a reminder that the meeting date is August 27th and that it will be the new pension by then, the new pension administers creating,
Meeting will
Everything.
be at 1:30 again.
yes, it'll be at the normal time.
So don't block our emails.
It'll be 9 or 10.
The fire is at 10. Normally, the police is at 1:30.
Right.
This meeting is early because this room is, had a meeting at 4 o'clock that couldn't get moved. So.
Okay.
Okay,
Is the motion to adjourn?
Motion to adjourn.
Stand adjourned.
Bye, guys. Nice to see everybody.
Thank you.
Yes.